Hi, this is Saturday, the 16th of September, and this is another episode of Two Grey Beards. Well, Andy, we've had an exciting week, and hopefully next week is going to be just as exciting as this one.
Yeah, I was super shocked with data, auctions, comments from central banks, and ultimately the markets didn't move that much. But I think we some noticeable things did occur. What do you think, Nick?
Well, the bond auctions went okay. Nothing to write home about. All the auctions were C's or B's in terms of scores, as it were. But what is noticeable is that all three of them are now underwater at the end of the week. So it just shows you the bond market keeps on trudging higher and higher in yield, and that's not going to stop immediately. Equities closed on the lows of the week, but an inside week. So basically a nothing burger. The OPEX went as expected. Basically, they ramped it up for the ARM yesterday IPO. They did it, they ramped it back down. So it's a nothing burger, really. The ECB, I thought, was very interesting because they hiked just as I thought they would, but they made it very clear during the press conference and in the statements they put out that they would like to be done. They hope that the data allows them to say that this was the last hike. Now, they try to walk it back slightly today in an article in the Financial Times, which I don't believe is what they want to put out, but they gave an impression that they had removed all optionality from the market, i.e., that they would not hike whatever the data said. And of course, that is not what they mean. They mean that they would like to be done, they hope to be done, but the data could make them go higher. And that is probably very much what we're going to get from the Fed, isn't it? They hope to be done and to be able to do nothing from now on.
Sure. Let's just review what we saw. Nick mentioned the auctions. In terms of US data, it was actually a little better than expected pretty much across the board. We had inflation figures. PPI were a little warmer than CPI, but even CPI was on the warm side, meaning inflation starting to tick up, particularly food at the energy sector, which we've seen the prices increase in gasoline and oil all summer. And jobless claims, no sign of this type of numbers that would lead to non-farm payroll firings, actual reduction in payroll. And so that's data just as chugging along. Now European data is noticeably weaker. The inflation is still noticeably higher than their target. So I think personally, I think they are hoping a lot that they're done and they'd like to be done, but I doubt they are. And we'll see. Who knows? We don't have to make that bet at this stage. For now, they're pausing. And so that speaks to what happens next week. So, what do we got next week, Nick?
Well, not much apart from the Fed. We've got some 20-year auction, but that's not going to be important. The Fed and what the Fed says and what the reaction of the market to the Fed, those are the important things. And really, the only thing to look from the Fed, because it's 90% certain that they're going to do nothing and the Fed hates surprising the market, is what are they going to do with the dot plots? And far more important than the dot plot for 2023, which they're not going to move from the 560 area for sure, because that you can't hike the dot plot and do nothing. That would make no sense whatsoever, especially this late in the year. So really the only thing to look at are the dot plots for 2024 and 2025. What do you think there, Andy?
Yeah, so just to clarify for our viewers what the dot plot is, every quarter, and this is one of the every other meeting, there are 8 Fed meetings. This will be a meeting where each of the Fed members says what they think about the future of the economy through 2025, and importantly, where they think interest rates will be at the end of each year. So, as Nick said, currently interest rates are at 5.5, and the Fed thinks that last quarter's dot plot indicated a final hike up to 5.6. And so they're not going to hike. I agree completely with Nick at this meeting. So now the question is, are they going to hike again? Right now, it shows the 2023 prediction by the Fed is that there's about a 40% chance they hike one more time before year end. That's what it is. Now, are they going to change that? Probably not. They're going to want to say in the statement that they are not hiking this meeting, but they may hike in the future, but they are nearing the end. And so that 5.6 number probably stays. But throughout this process, they've been saying that they are going to pause at whatever the terminal rate is. Let's say it's 5.5 for an extended period of time. And so people look at the guess that the Fed predicts of when they will start cutting. And currently, that dot plot shows a 4.6% interest rate at the end of 2024. Now, that says that they're going to cut 100 basis points in 2024. And I don't think Nick thinks that that the Fed is going to want to provide that message, and that what they're going to want to do is enforce the idea that they are going to pause for a long time by increasing the December 2024 rate from 4.6 to a higher rate, showing that they are not cutting for a while. And when they do cut, it'll be less. So that's the important data. And then the 2025 is also similar. That's the important data. And it seems to us that the Fed is going to either leave the data unchanged, which would be dovish, and is what is priced in the market at this very moment, or will move the December 2024 dot to a number like 4.9, which should be a 30 basis point increase and suggest that they're going to cut by only 70 basis points in 2024. And that would be a hawkish outcome of the Fed meeting. But that's the thing that people are going to focus on, is that particular dot, that particular piece of reporting that comes out, a document that comes out along with the 2 o'clock press statement. And we'll be ignoring the press statement. And frankly, we'll probably be ignoring the press conference after the press release, because the dot plot will tell it all. And so at exactly 2 o'clock, we'll have a fairly good sense of whether this is a hawkish outcome or a dovish outcome. And I would expect this hawkish outcome.
Well, if we do get this hawkish outcome, I think is going to be a wonderful opportunity to get out of the FRNs that we have, because those are cash-like. Now, why is that going to be a wonderful opportunity? Because if something like the 2-year note gets to a yield approaching 527 or 530, that would be actually, if we do some back of a cigarette packet, as we say in England, mathematics, it gives you, that yield gives you just about no negative carry if you hold the 2-year to maturity. But what it does do, it gives you duration and it gives you convexity, i.e., it gives you optionality. If we say that the Fed is likely to be done at a terminal rate of, say, 560, then unless inflation starts reaccelerating, it's almost certain that at some stage next year, they do start cutting, because otherwise real rates would keep on going higher and higher. So if inflation keeps on coming down along the path that they have projected, and let's face it, it has been so far this year, it's been coming down just about at the speed and at the rate that they have been projecting, to the levels they've been projecting. In that case, if they don't start cutting by the middle of next year, we're going to have a situation where we're going to have Fed funds 2.5%, 3% easily above the level of inflation, i.e., a real rate in the high twos of Fed funds. Now, we haven't seen that for a very long time. We haven't seen that since the 90s, I would say, or possibly 2000, 2001. And in that case, buying the 2 year note around the 275 to 527 area, I'm sorry, really it becomes almost a no-brainer, I would have thought.
Yeah, I agree. And that's what I'm going to be doing for my own money. I'll be moving my own cash from bank accounts that are paying money market mutual fund rates or T bills that are 1 month, 1 or 3 month in duration out to 2 year duration, because now finally you would be getting paid for the risk. And so that's what we're advising in well, that's what we'll be doing in our portfolio here at Two Gray Beards is if we get this hawkish number like a 490 rate in 2024, that will cause market participants to push 2 year yields to 5.25, and we'll be looking to buy them there.
Yeah, absolutely. And I'll cover this and some charts on 5.25, 527, why it's so important in my next segment. And I'll show you where our bids are going to be. And so we're going to be selling all our FRN cash-like instrument. And then what we will do is we will be buying the 2 year ETF, which is, I mean, not IF, it's going to be Shy. That's the one. I always get those confused. It's going to be Shy. And we will leave I'll cover that in my section
Sure.
about
Let's
which
just,
uh,
let's
which
just
level we buy.
yeah, let's just step back a little bit. And we've seen long-term interest rates ticking up and up, and they're not at their summer highs, but they sold off quite a bit today, but they're not yet at their summer highs. But it looks to us that, long-term bonds yields are going to continue to tick higher and make new highs for the post-COVID cycle. And so we're not a buyer of long-term bonds. We are going from cash to 2 years, and eventually we'll go from 2 years to 5 years, and then from 5 years to tens and thirties. And we'll be walking you through that journey as the yields hit our target. Just like 5.25 is a good target for 2 years, there's yields of tens and fives, tens and thirties that we'll start walking out to as time goes on. But given that trend given what we expect from the Fed, which is this hawkish walking up of the 2 year yield, and its implication on long term bonds, and the supply issues that we've mentioned before, we expect these yields to climb, and that'll continue to make equities unattractive. And so that's the last step of building our portfolio, I suspect, is we're going from cash to twos, we'll go from twos to tens and so on. And then ultimately we'll increase our equity up to a more normal standard. But today is not the day for that.
No, in fact, we are hoping that this backup in yields, especially at the long end, because of all the supply, all the duration supply, finally manages to hit equities, and they get rid of these ridiculous ideas that they have. They're going to have huge earnings upside in 2024. And when that happens, the journey down in equities should be very quick, because people will switch from equities into bonds. And then we will be able to do much the same, the reverse ourselves. Well, hopefully by that stage, we'll be long of bonds, and then we'll be able to sell the bonds when they rally and buy equities when they dip, and
Yep.
have a much more normal allocation for the long term.
Yep. And so that's how we expect it to play out. And it's just the beginning of that. Right now, we're bumping our head up against 20 PE. We're well into the 19s yesterday, and we still have 12% earnings expectations built into the market. And those just aren't going to work. Equities can trend higher, and there's trades to do, but as a long-term investment, we're going to take our time buying them.
Excellent. And, whatever the Fed does, we'll most probably send you an email after the event and we'll tell you where we're buying shy, if we're buying it, if what we expect to happen happens.
Yep. Sounds great. Nick, we'll see you. We'll talk this week and we'll see you next week.
Absolutely. And we'll send you an email on Wednesday. Bye.
Great. Bye.
So let's have a look at the portfolio. As we emailed you on Thursday, I believe, we bought 310 shares of shy. So we increased allocation by 10%, as we said. So now we have 37% in bonds, still about, the minimum that we can have in equities. And we've reduced the cash to about 33%. Now, everything else is updated. What I'd like to make you aware of is that I've added this link to the yield curve, which you might find useful as I'm going to talk about the 2-year note. And this is the order that we are putting in to be filled, hopefully, if the Fed does as we think and increases the dot plots for 2024 and 2025. In which case, we think that shy might trade down to 80.65. And at that level, we will be selling all of our USFR and we will be buying the equivalent amount of shy. And we think that amount is just about 480 shares. It might be slightly more, 483, but it's not going to make any difference. In any case, what we're saying is that we're going to get out of cash and cash-like instruments and go into the 2-year note. And as Andy said, over time, as duration backs up, we'll be walking this position from shy into IEF, into TLT, and so on. In any case, that is the intention. And now let's have a look why the 527 level in 2-year notes is so important. This is a weekly chart of the 2-year note and its yield. And as you can see, 527 is where it got to in 06 and caused a precipitous decline because of the stock market and the economy. Now, it's also where we bounced off many times back in the 90s. And really, it's a level, as we said, that offers for the first time the possibility of not having negative carry throughout the life of the 2-year note. And therefore, we think it's a wonderful level. Is it going to be the top? Who knows? But we think it's the first level that makes sense to transfer money from cash-like instruments like an FRN into fixed income at the short end, because the likelihood is that for the first time you don't have negative carry throughout the life of your position. And that is why we're doing it.